Hello everyone, it's great to see you guys here again at Forex Basics Lesson number 7. In this video, we'll be covering quite a bit of information, so don't be afraid to pause it or to revisit the contents even after you finish watching the video. In the last lecture, we discussed long order, short order, and close orders. In here, we'll continue learning basic concepts in trading Forex. Specifically, we'll discuss market order, limit order, and stop order. When a trader buy or sell a currency pair, there are two basic execution order types that can be chosen. The first one is market order. A market order is an order to buy or sell a currency pair immediately at the best current market price. It is always the default option in your trading platform. A market order deals primarily with speed. Price is actually secondary. Another important basic execution order is called the limit order. A limit order is an order that allows you to set a price you're willing to sell or buy a currency pair. Once the market price hits your target price, the order gets executed automatically. If the market price never hits your set price, your order won't get executed. In other words, price is the essence for a limit order. So when to use limit order and when to use market order? To use a market order, it is when you believe that there is a strong trend in the near future, and when you want your order to be executed as soon as possible. In other situations, however, at Market Newbie, we advise you refrain from using market order. This is because Forex market is a 24-hour market. It is very unrealistic to stay watching it all the time and wait for the market to reach the price that you want and then place your market order. We recommend using limit order instead. Limit order ensures that your order gets executed at the right price instead of chasing after speed. The other reasons include the spread and extreme market fluctuations, which we will discuss in the later slides. However, we do have to admit that there is a shortcoming when it comes to limit order. That is, if the market never gets to the price you set, then it never gets executed. You might lose a few opportunities. However, that's okay, because opportunities in the Forex market are countless. Another important concept we want to introduce here is bid and ask price. The bid and ask price represents the supply and demand for a currency pair. Bid price represents the maximum price that a buyer is willing to buy. Ask price represents the minimum price that a seller is willing to sell. It is important for us to remember that the ask is always higher than the bid. For instance, Australian dollar to US dollar currency pair is currently quoted at 0.7359 to 0.7364. This means that the buyer is willing to buy at 0.7359, which is the bid price, and the seller is willing to sell at 0.7364, which is the ask price. As a trader, you just need to remember, when you are longing or buying, always check the price that is higher. And if you are shorting or selling, always check the price that's lower. This leads us to spread. Spread is the gap between bid and ask, and it is measured by pips. Remember pips we discussed earlier? It represents the changes in currency quote. Let's go back to this example. Australian dollar to US dollar currency pair. It is quoted at 0.7359 to 0.7364. The former is the bid price, and the latter is the ask price. The difference between the two is spread, which is 5 pips. When a trader places a market order, he or she is willing to buy at the ask and sell at the bid. the trader is immediately out of money because of the spread. And this is one of the reasons why we recommend using limit order instead of market order. Pop quiz: what does out of the money mean? If you don't know, check out our basic or option videos. Another reason of why we should use limit order rather than market order is extreme market fluctuations. In the Forex market, there is full of news and data release. Traders will see sudden spikes and dips all the time. And if you use the market order, you might sometimes get a price that you really don't want. Let's say you want to trade euro to US dollar currency pair. The price is currently 1.1652. You want to buy or long it, so you place a market order. All of a sudden, the price increases by 30 pips and it reaches 1.1682. So instead, you will have to pay 30 pips more to buy it. Even worse, an hour later, the price dropped back down to 1.1652. So now your currency quote is worth less. As you can see, such extreme market fluctuations make market order a very undesirable technique when it comes to Forex trading. Although the scenario that we discussed might have a version that you actually benefit from sudden market movement after you place a market order, you really don't want to bet on your luck. Under limit order, there is another special type of order, which is called stop orders. Stop order basically helps you cap your potential maximum loss and maximum gain. Stop order can be further divided into stop loss and stop win or take profit order. Stop loss order is an order to close a position when the market reaches a certain price. When you have a long position, the stop loss is below the market price. When you have a short position, the stop loss is above the market price. In other words, the stop loss order caps the maximum loss. Stop win or take profit order is an order to close a position when the market reaches a certain price. When you have a long position, the take profit order is above the market price. When you have a short position, the take profit order is below the market price. In other words, the take profit order caps the maximum gain. For example, if a trader has a long position for a currency pair, he or she can set a take profit order that's above the current market price and a stop loss order that's below the current market price. Say for now, you want to trade a euro to US dollar currency pair. The market price is at 1.1702. You can then set a take profit price at, let's say, 1.1902 above the market price and a stop loss price at 1.1602, which is below the market price. Once the currency price hits either of these prices, it will automatically close the position at either of them. Therefore, you can see the stop orders help you cap your potential maximum loss and maximum gain. A few take-home messages. The two basic execution orders we discuss here are market order and limit order. As newbies, we recommend you using limit orders in most cases. To cap your maximum loss and maximum gain, you can utilize stop loss and stop win or take profit orders. Coming up next, we will discuss risk management in Forex trading. This is one of the most important and interesting topics in trading, and we recommend all newbies to learn about this before you start your trade. Thank you again for watching our videos Forex Basics series. If you want to learn more about Market Newbie, visit us at www.marketnewbie.com. Follow us on Facebook and Instagram. See you in the next lecture.